Have you ever seen a country's currency drop so low that a single dollar could practically buy its entire economy? That's exactly what's happening with the Japanese yen right now. It has hit its lowest exchange rate in the past 40 years. This isn't just a number on a chart. The yen's decline is affecting millions of people, from tourists to major corporations. But what does this look like in real life? Imagine this. $1 is currently worth around 160 yen. For comparison, in 2012 it was only 80 yen. This means that for the same amount of money, an American can now buy twice as much in Japan as they could 12 years ago. Ever wanted to try premium Wagyu beef or stay in a 5-star hotel? Now it's no longer just for millionaires. Back in the 1980s, land prices in Ginza, Tokyo's central business district, soared to $139,000 per square foot. To put that into perspective, a small office in Ginza was once worth as much as all the land in downtown San Francisco, even by today's skyrocketing real estate prices. But now, land values in Japan have plummeted by more than 80%. Imagine owning an apartment in Moscow that, in the 1990s, was worth the same as an entire neighborhood in the heart of New York City. Now, it's worth so little that you could barely afford half a similar home in a small provincial town. That's exactly how the Japanese felt when their once prized real estate, a symbol of national wealth, suddenly collapsed in value. The Imperial Palace in Tokyo was once considered the most expensive piece of real estate in the world. In 1989, its estimated value was a staggering $852 billion, more than the entire real estate market of California at the time. And today, it's simply a cultural landmark, no longer a reflection of Japan's former economic dominance. It's as if Big Ben in London suddenly lost so much value that it was worth no more than a small-town city hall, and tourism revenue couldn't even cover half of its maintenance costs. The yen's weakening isn't just a financial statistic. It's an economic drama involving billions of dollars, thousands of corporations, and the fate of entire generations of Japanese people. But the big question remains: what happened to an economy that was once considered a global model for success? The yen's plunge to a 38-year low isn't random. It's the result of complex economic forces within Japan and beyond. Right now, $1 gets you about 160 yen, practically a historical low. But what's really behind this decline? In 2024, the number of tourists visiting Japan skyrocketed to 900,000 in just 5 months, a 17% increase compared to the same period last year. The reason? The weak yen has made traveling to Japan incredibly affordable. For example, a tourist from the US who could afford a simple meal at a regular restaurant in 2019 can now indulge in a feast of premium sushi made from the most expensive tuna, or dine at Japan's most exclusive restaurants for the same price. Hotels and vacation rentals have become so budget-friendly that many travelers are extending their trips, and some are even planning multiple visits within the year. Interestingly, it's not just tourists benefiting from the yen's decline. Luxury shoppers in Japan, buying brands like Louis Vuitton and Gucci, are also getting a bargain. Many high-end products have become cheaper due to the exchange rate, attracting shopping enthusiasts from all over the world. But have you ever wondered why Japan feels so affordable for foreigners, while the locals seem baffled by the situation? The answer is that the yen's depreciation has affected every single person in the country. For tourists, it's a goldmine: lavish meals at bargain prices, world-famous brands for the cost of a regular jacket back home. But what about businesses? Global corporations are seizing the opportunity to buy Japanese technology and equipment at a fraction of what they would pay elsewhere. For the Japanese, however, this is far from good news. Prices of imported goods, everyday essentials like coffee and fruit, are rising at an alarming rate, yet wages have remained stagnant. Imagine saving money each month, only to realize that your purchasing power is shrinking. That's the reality for millions of people in Japan today. And this isn't just a local issue. A weaker yen makes Japanese products more competitive in the global market. Sounds like a win, right? But for manufacturers in Europe and the US, it's a nightmare. Cars, electronics. Japan can now sell them at lower prices, outpacing its foreign competitors. So, what happens to the global economy if this trend continues? And how did a once powerful economy, admired worldwide, suddenly lose its edge? In the 1980s, Japan was at the height of its economic dominance. It seemed as if the country had not only caught up with, but even surpassed the US. Back then, Japan's economy was synonymous with cutting-edge technology, reliable cars, and unshakable financial stability. Yet this success story turned out to be the prelude to a dramatic collapse. During the 1980s, Japan's stock market was the largest in the world. The total market value of Japanese companies made up nearly half of the global market capitalization, over $4 trillion. For comparison, the US stock market at the time was worth about half as much. It's as if Apple and Amazon stocks suddenly became worth more than all European companies combined. But in Japan, this wasn't just about two corporations. It applied to almost every major company. The problem? These companies weren't making money from their products. They were profiting from real estate speculation and stock trading. With this frenzy, everyone wanted to invest in the market. IPOs, initial public offerings, were so popular that people bought stocks without even knowing what the companies did. On average, stock prices surged by 32% on their first day of trading, creating the illusion that anyone could get rich overnight. However, this economy was like a house of cards built on credit and speculation. Everything looked dazzling, until people started asking uncomfortable questions. What happens if prices stop rising? Have you ever thought about how a single international agreement could turn an entire nation's economy upside down? In the mid-1980s, Japan was at its peak. VCRs, cars, electronics, everything made in Japan was in high demand. But in 1985, something happened that changed everything. The Plaza Accord. This agreement aimed to make the Japanese yen stronger. At first glance, that might sound like a good thing, right? A stronger currency should mean a stronger economy. But here's the catch. The more valuable a country's currency becomes, the more expensive its goods are for the rest of the world. Suddenly, Japanese products, cars, electronics, went from being affordable and popular to luxury items. As a result, Japan's exports plummeted, and with them, corporate profits. To counteract this, Japanese authorities tried to boost their domestic economy. They slashed interest rates, making loans much cheaper. And you know what happens when money becomes almost free? People start buying everything: stocks, land, real estate, hoping to cash in. This kicked off one of the biggest speculative frenzies in history. Japan seemed to be on top of the world, but beneath this economic strength was a dangerous addiction to speculation and cheap money. As the bubble inflated, it felt unstoppable, but every bubble bursts eventually, and Japan found itself on the brink of economic disaster. In the early 1990s, Japan's real estate market collapsed, with property values in major cities plummeting by 84%, wiping out trillions of dollars in wealth. This wasn't just a downturn, it was a catastrophe. Millions of families lost their investments, and many ended up in a nightmare scenario where their homes were worth less than the loans they had taken out to buy them. Imagine buying an apartment for $500,000, only to see its value plunge to $80,000 a few years later, while the bank still expects you to pay off the original loan amount. This was a massive shock for the Japanese, who had grown used to the idea that real estate prices would always go up. This crisis gave birth to an entire generation of zombie companies, businesses so buried in debt that they couldn't grow or invest in the future, yet couldn't shut down either, as they were propped up by government subsidies. At the same time, Japan's stock market collapsed by 80%. By 2003, its total market value was lower than it had been in the 1980s. For comparison, during that same period, the US Dow Jones Index nearly doubled in value. The Japanese investors who had put their savings into stocks lost everything. Quite literally, it's like betting your savings on major companies like Tesla or Google, expecting their stock prices to rise only to watch them crash by 80%. For thousands of Japanese citizens, this nightmare became a reality, destroying their financial security and confidence in the future. How did this happen? One of the key reasons was excessive deregulation and weak oversight of financial institutions. Banks were handing out loans to anyone, ignoring the risks. People borrowed money to buy assets, assuming their value would only keep increasing. But when the market crashed, no one was prepared for the fallout. The most striking part? Japan's economy continued to suffer from the crisis for decades. Why was the recovery so slow and painful? At first glance, the yen's decline seems like a problem that only affects Japan, but the reality is far more complex, because economic troubles in one country can quickly have global consequences. The yen is one of the world's leading currencies, and its fall sends shockwaves across international markets. How does this affect the rest of the world? And what if this is about more than just financial news? A weaker yen makes Japan an attractive destination for tourists and foreign investors. Essentially, the Japanese economy has become discounted for those holding stronger currencies. On the other hand, the yen's decline impacts the entire global economy, as Japan is a major player in the technology and automotive industries. A cheaper yen means Japanese products become more affordable in international markets, which can undermine the competitiveness of manufacturers in other countries. For example, Toyota and Honda can now produce cars at more attractive prices, creating serious challenges for American and European automakers. Japan's bond markets are also becoming less attractive to investors. Interest rates in Japan have remained near zero for years, and the country's central bank has even tried to stimulate the economy by pushing rates into negative territory. But despite these efforts, the expected economic boost hasn't materialized. Meanwhile, the weakening yen means that Japanese bonds have become even less profitable for foreign investors, as their returns in yen are losing value. Imagine investing in Japanese bonds when interest rates were still negative. In the end, you're not just losing money due to the low yield, you're also taking a hit from the yen's decline. It's like putting your savings into an investment, only to have an inflation monster constantly eating away at your returns. For everyday people, this could also lead to higher prices on imported goods. To compensate for losses caused by the weak yen, Japanese companies might raise prices on their products. This means that, despite Japan's currency losing value, we could still see price increases on Japanese cars, electronics, and other goods. So the yen's decline isn't just a local issue. It's a warning sign of potential economic troubles that could ripple across the global economy. But how can we, as ordinary citizens, prepare for these consequences? And what can we do to prevent a similar financial crisis in our own countries? Share your thoughts in the comments. Thanks for watching.